Hello. One of the quietest yet most powerful inventions in human history is undoubtedly money. Though it may not attract attention like the grandeur of palaces, the size of armies, or scientific breakthroughs, the true instrument that enables societies to function is this simple concept that facilitates the exchange of value. Money is not merely a medium of trade. It has become one of the cornerstones of civilization. In the earliest times, people relied on direct barter to meet their needs. But this system faced significant obstacles due to the lack of a standard measure of value and the limited variety of goods. It was precisely at this point that money emerged as a common unit of value, shaping humanity's economic memory. From seashells to gold, from paper to digital data, this journey provides a key to understanding civilization itself. Looking back today, money is more than a tool for exchange. It is a symbol of power, trust, identity, and even freedom. This journey, from the limitations of barter to the digital revolution of cryptocurrencies, reflects both humanity's needs and its aspirations. The birth of barter. The primitive definition of value. One of the most fundamental questions in human history was, how can what you have be transformed into what I have? Early communities sought to answer this by exchanging hunted meat, gathered fruits, or simple handmade tools. Survival depended not only on using what one had, but also on accessing what others possessed. The barter system arose from this side. Yet, for it to work, both parties had to simultaneously require what the other offered. Economists refer to this as the double coincidence of wants. Back then, no one cared about the terminology. The only concern was not going hungry. For example, a potter wanting a piece of meat in exchange for a pot had to find a hunter who both wanted a pot and was willing to trade meat for it. Such balance was rare and often failed. Other problems also existed. Portability was limited. A cow might be worth more than a sack of wheat, but transporting it to the market for exchange was impractical. Perishability was another issue. Milk spoiled in days, fish in hours. Barter was unreliable both physically and temporally. Gradually, people recognized that certain goods could serve as a more general medium of exchange. Seashells, salt, spices, durable, portable, and desirable by all, slowly began to function as primitive money. Value was no longer measured solely by personal need. Objects started being accepted as a common unit of value within the community. This marked a turning point for humanity. While barter laid the foundation for trade, its limitations necessitated a more advanced medium. Eventually, a system capable of functioning as a medium of exchange, measure of value, and store of value became inevitable. That system was called money. The first coins, the power of metal, and Lydia's legacy. The challenges of barter drove humanity toward a universal and lasting medium. Metal coins. Naturally occurring metals, especially gold, silver, and bronze, were durable, portable, and scarce. making them intrinsically valuable. These qualities transformed metal from mere ornamentation into an economic symbol. Around 2,600 years ago, the Lydian kingdom, located in present-day Turkey, minted the first known metal coins. Made from electrum, a natural alloy of gold and silver, these coins combined the physical properties of metal with the authority of the state to establish a system of trust. Each coin bore a stamp, signifying that the value behind it was guaranteed by the king's power. This revolutionary invention fundamentally changed economic relations. Value no longer depended solely on a commodity's physical existence, but on recognized symbols inscribed upon it. The Lydian coin brought trust and ease to trade, increasing economic activity while reinforcing state authority, as the legitimacy of money was directly tied to governmental power. The model quickly spread, from Greek city-states to the Persian Empire, and eventually to Rome. Not just metals, but the stamped symbols on them conveyed meaning. The emblem of a king, emperor, or republic became the primary determinant of a coin's validity. These first coins represented humanity's first attempt to materialize the abstract concept of value. This milestone shaped not only the economy, but also political and social structures. The reign of gold, the universal measure of wealth. Perhaps the most illustrious chapter in monetary history is written in gold. Durable, rare, and aesthetically captivating, gold was adopted by diverse civilizations not just as jewelry, but as a universal measure of value. In the ancient world, gold symbolized not only trade, but also power and prestige. Pharaohs' tombs in Egypt, royal seals in Mesopotamia, spoils of war in Central Asia, all share a common element: gold. It does not corrode, decay, or rust, and can be melted and reshaped. These properties rendered it both economically practical and culturally sacred. During the Roman Empire, gold coinage was institutionalized on a large scale. The aureus, a gold coin, circulated throughout the Mediterranean, backed by Rome's authority. Bearing the emperor's portrait, these coins demonstrated that money was both an economic tool and a medium of political propaganda. For centuries, gold underpinned state power and wealth. Countries with overflowing treasuries were considered rich. Wealth was measured not in land, but in gold, and many wars were fought over access to mines. The principle, "He who controls gold, controls the world," was often more than a proverb. It was a political reality. This era also laid the groundwork for the gold standard, where money was directly tied to gold reserves, reflecting a time when economic security relied on tangible foundations. Gold became a symbol of trust, value, and global commerce, a high point in money's evolution, yet only a transitional stage. The birth of paper money from China to Europe. Despite gold and silver's value, their weight and scarcity posed practical challenges, especially for long-distance trade. The solution emerged as a revolutionary idea: money divorced from physical bulk. Thus, paper money entered history. The earliest examples appeared during China's Tang dynasty in the 7th century, but it was under the Song dynasty in the 11th century that the system became institutionalized. Merchants used government-issued paper certificates, backed by a guaranteed amount of metal instead of carrying heavy coins. Value shifted from the object itself to its representation. This innovation eased transactions and laid the foundation for modern financial systems. Paper money relied on trust. People believed not in the paper but in the authority that issued it. The abstraction of value enabled the development of sophisticated economic concepts. Paper money spread via the Silk Road to the Middle East and Europe, though Western trust in it lagged behind the East. The first European banknotes emerged in 17th-century Sweden and England, initially as portable bills that gradually became accepted for direct transactions. Paper money allowed the economy to centralize and abstract, enabling states to issue currency not strictly backed by gold. This development paved the way for modern monetary policy and central banking. Once tangible, value now rested on narrative, system, and authority. Paper money was the first major representative of this transformation. The rise of banking, storing and distributing money. With paper money's proliferation, securing and managing currency became crucial. Here, the institution that forms the backbone of today's economy emerged: the bank. The earliest banking practices appear in ancient Mesopotamia, where temples safeguarded grain and valuables in exchange for written receipts. Modern banking, however, took shape in medieval Italy's commercial cities, Florence, Genoa, and especially Venice, which became centers of both art and finance. Merchant families and bankers offered secure storage for precious metals, issuing receipts that evolved into a representative currency. Physical circulation declined, while symbolic money gained prominence. The establishment of central banks in Europe during the 16th and 17th centuries formalized this process. The Bank of England, founded in 1694, not only issued money, but also managed government finances. Money became a tool of power not only between individuals, but between states. Banks extended beyond storage. They became lenders. This multiplier effect enabled transactions based not only on current holdings, but future earnings. Concepts like debt, interest, and deposits flourished. Banking became the brain of the economy, managing and circulating currency while shaping growth and crises alike. The end of paper, cards, ATMs, and digitization. By the 20th century, economies grew more complex and transactions accelerated. Paper money remained central, but a new era emerged: electronic transactions and digital finance. It began in the 1950s with the introduction of credit cards in the United States. Diners Club offered customers cards to pay without carrying cash, initially valid only at select restaurants and stores. This small step marked a major leap from physical to digital money. Banks soon issued their own credit and debit cards, enabling cashless, rapid transactions while enhancing traceability. ATMs arrived in the 1980s, offering 24/7 access to funds, and online banking later diminished the need for physical branches. Money became data. A few digits on a screen could transfer millions. While paper currency persisted, modern society increasingly relied on digital balances. Cashless societies like Sweden exemplify this transformation, where physical money is nearly obsolete. This shift is more than technological. It represents a fundamental change in how we perceive value. It now exists in the digital realm, in the cloud, and even in QR codes. Cryptocurrencies, a decentralized future. 2008 marked a turning point. The global financial crisis shook trust in banks and central authorities. Amid this uncertainty, Bitcoin emerged, a radical alternative to traditional money. Bitcoin was not issued by any government or central bank, but introduced via a technical paper by the pseudonymous Satoshi Nakamoto. Its promise, secure, transparent, and censorship-resistant transfers without intermediaries, powered by blockchain technology. The blockchain is an encrypted, sequential, and irreversible digital ledger. Control of money shifted from central authorities to a distributed network. Cryptocurrencies arrived with ideology, financial freedom, privacy, transparency, and decentralization. Bitcoin paved the way for Ethereum, Ripple, Litecoin, and thousands of others. Entirely digital, independent of traditional banking, they are both revolutionary and controversial, offering freedom yet risking instability. Even central banks are responding, exploring digital currencies, CBDCs. The future may see state-backed and blockchain-based money coexist. The social meaning of money. Status, power, and psychology. Money is more than an exchange tool. It is a symbol of status, success, power, and confidence. Throughout history, it has shaped social influence and defined one's place in society. In ancient times, precious metal coins were held by the elite. Displaying them signaled social class, luxury consumption, clothing, accessories, vehicles became associated with wealth. Today, the relationship deepens. People are judged not just by possessions, but by how they earn them. Wealth can signify praise or symbolize exploitation. Psychologically, money strongly influences decisions, triggering emotional reactions, risk-taking, or fear-driven behavior. Socially, it exposes inequalities, as access to education, healthcare, and culture largely depends on income. Digital wallets, investment portfolios, and brand affiliations further complicate money's social impact. The story of money. Humanity's reflection. Money is not merely paper in our wallets or digits on a screen. It is a quiet yet powerful narrator of human history. It reflects how societies live, govern, value, and pursue. From barter to coins, paper, plastic cards, and virtual codes, each stage illustrates not only technological evolution, but the evolution of human thought, expectation, and fear. As money transformed, so did our approach, control, and relationship with it. Some befriended money, some opposed it. Some saw it as a tool, others as life's purpose. For some, it meant freedom. For others, bondage. Yet, money always shaped commerce, politics, war, peace, and civilization. Today, money exists not just in our hands, but in algorithms, blockchains, and digital platforms. But we still govern it, or so we believe. Although man-made, money has grown into a force that shapes habits, lifestyles, social relations, and even dreams. Thus, the story of money is not just about it. It is ours. Humanity, in creating money, revealed its inner world. Born of necessity, it became a symbol of value, trust, power, inequality, opportunity, and disappointment. And perhaps most importantly, the journey of money is not over. Humanity is still searching for what is truly valuable. Money, one of humanity's simplest yet most complex inventions. We have held it, stored it in wallets, watched it as numbers on screens. But in truth, money is more than a tool. It is the mirror of civilization. From the primitive scenes of barter to the reign of gold, from the revolution of paper money to digitization and the challenge of cryptocurrencies, this journey is our journey. At each stage, not only did value change, but humanity's view of itself, society, and the future transformed. Today, money has ceased to be a tangible object. It lives in invisible networks and algorithms. Yet, we must remember, humans invented it, and humans assign it meaning. The essential question is not what money is, but what we make of it, because true value is not in gold or paper. It is in human conscience, labor, and dreams. And perhaps that is why the story of money is not over. Wherever humanity goes, it will take on new faces alongside us.